to start by saying that really I think that Maj is pretty grateful that I really got his career on track by signing up to do these with him. It spearheaded his career, right, Maj? All right. So Heritage Global, two businesses, one company, industrial assets and financial assets. Industrial assets is a legacy business really started by my grandfather. It does three things. It does auctions as a principal, where it buys the assets and resells them, often in distressed situations. It services Fortune 500 companies as a fee-based auctioneer on commission. That business is rapidly growing right now because we saw a lot of M&A and we saw a lot of pressure on the large Fortune 500 companies to manage their surplus better, to keep it out of landfill, to put it back into the secondary market. So that's pretty much a rapidly growing segment. The distressed business comes and goes with plant closures, and right now we've seen a lot of layoffs and a lot of action. That's the industrial auction business, 200 auctions a year. It's complemented by a valuation business that works for money center banks. That business grows when people are worried about their collateral. When they're worried about their collateral and not the enterprise value, they come to us to do the appraisals. That's fee-based. ALT is a company in the life science business that refurbishes and resells life science equipment. A couple of our largest clients are Pfizer and Amgen, but we sell to a lot of small biotech companies at the same time. Why is industrial asset business growing? It's going to grow over the next 2 or 3 years because more and more companies are now looking harder and harder at the surplus in their plants. There's a way bigger focus on the back chain of the supply chain in managing your surplus. There's pressure on these companies not to scrap it like they did in the old days, but to try to put it back into the circular economy. There's also a much bigger buying base of people who want to buy used equipment. So it's everything from pharmaceutical equipment to food processing equipment to chemical equipment, and we do it worldwide. Flip the switch to the other side, which is not the legacy business, but it's also an old business. NLEC was founded right after the S&L crisis. During the S&L crisis, we had big FDIC and RTC government deals. We sold billions of dollars of financial assets. That ended. We said, wow, we've got this big book of buyers and no sellers. We opened up NLEX not to work for the government, but to go out to money center banks. We were the first guys 25 years ago to walk into Citicorp, American Express, Diners Club, and say, we can sell everything you've written off down to zero. So we were the only guys that went in there and said, give us your worst crap. Everybody else wanted their performing loans. Everybody else wanted their decent product. And so we became the absolute junk dealer, the bottom feeder of the lowest possible loans anybody could sell. We were selling loans then for 2 and 3 cents on the dollar, but there was billions and billions of dollars of product. Flash forward 25 years, they've invented in the last 3 or 4 years the most incredible products, and it's why we're growing. It's almost like if you're an old-time liquidator, my grandfather would have called it a mitzvah, the things they've invented. They invented this thing called buy now, pay later. Buy now, pay later is an auctioneer's dream because everyone will not pay later. So it's really growing now. You put people on a cruise ship for a week, they go out, they have rum and cokes, and they lose all their money in the casino. They get off the boat, and you bill them to pay now. They don't pay now, and they don't pay later. So we sell those loans on a regular basis. That entire business, NLEX, selling non-performing loans, is growing because we're looking right now for the first time ever at $1 trillion in credit card debt. We're the largest seller in the world of charged-off credit card debt. We're looking now at consumer debt at the highest rate it's been in history. So that business is solid. The flip side is a specialty lending business there where we lend to the buyers of those products. Is that 5 minutes, Maj? You timing me? Ready to go? You got any good questions?
Yeah, have us come on down.
All right.
Yeah, you know, you can get comfortable. So, but one thing I want to talk about here, Russ, is that, we keep talking about how you guys will do in a bad economy or stressed economy or stressed consumers when consumers when they're stressed. But this isn't just a situation where you guys do well in that type of environment. You guys can grow in a decent economy too. So I think that messaging it maybe gets lost a little bit and could affect valuation. So I want to maybe speak on that a little bit.
Sure. What happens is when you get branded by being the guys that did Enron, the guys that did Obama Solyndra auction, when you're selling distressed assets, you get this grim reaper, you're only going to do good in bad times, which is actually a misnomer. We do probably better in a really bullish economy, not tied to where the Dow is going, not so much tied to unemployment figures, but tied to M&A. Nothing creates more asset surplus than the strongest bull economy where companies are acquiring each other. I've been doing this for 40 or 50 years. Our best years were when there was a lot of M&A. I mean, in the 90s, when all the defense companies bought each other and Lockheed bought Martin Marietta, we did tons of auctions. Right now, you're looking in the pharma sector at the big pharma guys having hundreds of billions of dollars of cash and needing their next product. So when they go out and do an acquisition, they want the scientists, Maj. They want the intellectual property. They want the patents, but they don't necessarily need another tablet plant or another, ointment plant. So it creates a lot of asset flow for us. So we can do great in a good economy. We struggle in a boring economy where the lenders are afraid to foreclose because they don't want to take the hit. So we had a killer Q4. Why did we have a world-class Q4? Because all the banks were in a hurry to try to write off a lot of their bad loans in that quarter. All the corporations wanted to sell non-performing assets in that quarter. So it's a lot of micro times. And that's why I think the next 2 years, we got a big run.
Great. That's good. So you can grow in most conditions, which I think gets lost. And I think the more you talk about that, maybe help the valuation moving forward, right? And
I don't think I can say anything to put yourself to valuation at this point.
That's true. I want to talk about the lending business a little bit here, and your brokerage side of it. It seems like a pretty cool platform. So maybe talk a little more about how that actually works. Maybe take us through a case study. Customer comes in, uses it, and then you get a big idea.
So big auto lender like Santander would come to us and say, we've charged off $100 million in auto loans. We've tried to collect from a primary agency. We've called the people. We've written to people. We've went through a tertiary agency. We're writing this down to zero, the $100 million. What is the residual value? We look at the tapes. We look at the files. We say, we think we can sell it for 10 cents on the dollar to a collection agent. And they say, okay, $10 million is better than zero. Go ahead and do the offering. It's very specific on how we do the offering. Everything is locked in vaults on the information because there's massive privacy on everybody's Social Security and credit cards. So there's a big cost of entry of entering that business. Also, Santander is a bank. They care very much about who I sell it to. They don't want me to sell it to somebody who's going to go knock on doors and bother the people. So there's a lot of supervision there. So we do the offering and we sell it.
Okay.
And so somebody buys it for $10 million. That buyer may come to us and say, will you finance us, which would be Heritage Global Capital. We would then lend them part of the money at a high interest rate, okay. Or they may have their own capital.
Okay.
And we do 200 of those a year.
And the ability to scale that, what does that look like? Is it, maybe talk about how that scales and what's required?
So 95% of that business is not done by brokerages. 95% of that business is done by banks with recovery departments. So Citibank has their own recovery department at Wells Fargo, but every year you see another fintech company raise $500 million, $1 billion. They don't have big recovery departments. So we're adding clients month over month. Also, there's a lot of pressure now on all of the regional banks to clean up their balance sheets. So we're adding regional banks. So it can grow for the next 3 or 4 years just on a combination of fintech lenders and regional banks at a pretty rapid pace. Last year was our best year. We're forecasting this year to beat it.
Okay, excellent. And would you say that's more of a consistent growth opportunity, like in terms of predictable than the asset side of the business?
It's the easiest part of the business to forecast because most of the contracts are forward flow 1 and 2 year contracts. So it's very easy and much less episodic than industrial auctions.
Right.
Where industrial auctions, we can make $1 million one quarter and $3 million the next quarter if we get some very large transactions.
Okay.
So there's basically a baseline business there that's easy to forecast.
Right.
That's currently undervalued, by the way.
Right. I believe you. So, and I guess that is what you struggle with a little bit, right? In terms of when you're talking to investors, right? I'm assuming they talk about the lumpiness in the asset side of the business, but
it's less and less lumpy now and more predictable because we've grown the financial assets, which is very predictable. The lending is very predictable, and we've increased our forward flow industrial clients, which is very predictable. So we know 100% we're going to do an auction every month for Pfizer. And there's multiple other clients we know we're going to do an auction for every month. The business is getting more predictable. I tell people I used to have a visibility of making $5 million a year, and I was pretty proud of that. I now have the visibility of making over $10 million a year before we hit the episodic part of it. So if I know we can make $10 million without any of the episodic deals, I'm really comfortable that there's real value here because we've never had a year without episodic transactions in my history.
But you've had some nice quarters here where you grew without even any major asset sales, which was nice to see that too.
We've been growing organically because I wanted to get to a certain point organically where I knew we could make X amount of money every year before we really started pushing M&A. It was kind of like, let's get our act 100% together, and then when we're really confident that we got everything right, now we're pushing M&A. Now we're going out and actively looking for bolt-on companies to rapidly grow the business because everybody's saying, fine, we believe you got a $10 to $15 million business. How do you get a $30 million business? Well, one of the easiest ways to get a $30 million quickly is to not just do everything de novo greenfield, but also do a focus on M&A combined with organic. So that's where we are now, and we're looking hard.
Okay, and with your current back to the lending business, with the financial assets business, with the current capital structure you have right now and your balance sheet, I mean, where is there a certain max you can get to with? What's your capacity in terms of revenue?
I don't believe we'll have to raise any capital to do bolt-on acquisitions.
Okay.
We've got a credit line at $10 million. It's zero right now.
Right.
We've got $1 million in remittances coming back from our loans, and we're profitable. And we've got cash in the bank. So, and we've got a currency, albeit a currency that I don't really want to use at today's value. But
right.
we can do multiple deals without doing a capital raise. We've got a really strong balance sheet for our size.
Great. Oh, question? Go, Scott.
What's going on, Scott? I don't think we're going to have to again. I think we did enough right there. The loan book is performing. What happened is one of our largest clients, or actually our largest client, came to us and says, we believe 100% we can pay you off in full, but we need to extend the amount of time. And when we looked around and you look at the public companies, PRA, Encore, they're all saying the same thing. During the pandemic, there was very fast payoffs from the collection agencies on non-performing loans because everyone was getting stimulus checks and got a little spoiled, and the people were paying them off quicker when they were getting the stimulus checks. The collection curve slowed down now. So we took a loan loss reserve, not a cash reserve. We believe we're going to get paid in full, but it was a prudent thing today, and our auditors wanted to. Our loan book, think about it this way. Our loan book's at $40 million, and our market cap is at $250 million. When our loan book was at zero, our market cap was at $300 million. So as far as the safety net, the $40 million we had the same value before people owed us $40 million. So I feel pretty comfortable that we're going to get 100% of it paid back plus interest. But if the loan loss reserve turned out to be true, so we're not going to get $40 million back, we're going to get 38.5 back, Scott. So, it's a very conservative loan loss, and we did it at the same time that all the money center banks also did it. So we would have looked probably more suspicious if everyone else was taking a loan loss reserve and we didn't. So I feel comfortable. Yes, sir. Last year, industrial made more than financial. The year, 2 or 3 years before that, financial made more. It's basically a 50-50 race. Right now, financial is on track to make more this year just because there's a massive amount of financial supply. But that could change if we find a large deal on the industrial side. So I look at it as about 50-50 equal businesses. What industry is my targeting for growth? So on the industrial side, it's a combination of geographic expansion and sector expansion. So sector expansion is we're the number one pharma auctioneer. We're not the number one medical auctioneer. There are industrial asset categories we don't lead in that we do business in. So we're not the number one metal auctioneer. So basically, and also there's this massive push to do reshoring, and there's tremendous amount of auctions in Europe. We're doing one right now for Pfizer, but we don't have the real feet on the ground to expand geographically. That's on the industrial side. On the financial side, 92% of our revenue is consumer loans. Only 8% of our revenue is real estate loans, and everyone is talking about this massive growth in CRE real estate loans over the next 3 or 4 years. So some of that's organic. Some of that, under the right scenario, would be an acquisition, because I'd like to balance that business out so it's not just consumer loans, but it also has more CRE in it. Next question? Nope. You've got to come up with one then, Matt. Pressure's on you.
Let's talk about the competition now. And has anything changed in the last year we've spoken in terms of the intensity of it? Do you think you've gained any market share?
We've definitely gained market share in the financial asset business. We've definitely really dominated the consumer business there, because literally every one of the new fintech clients, we're the most referenceable one. So we've really grown our client base there. On the industrial side, there are 50 privately held industrial auctioneers in America. And the really good thing is a lot of them, I knew their grandfather and their fathers, and my nephew Nick, who runs it, knows their sons. So a lot of them are competitors, but also allies and partners. So we can grow that business without necessarily having to acquire these legacy family businesses, but to partner with them. So I feel good about our position in the market. So Ritchie Brothers has a $12 billion market cap. So there's really not a comparison. Think about them as outside the building, yellow iron and agricultural, 95% of the business. Think about us and most other auctioneers as inside the building, manufacturing assets. So manufacturing assets is a different skill set than their skill set. They're a real estate play. They have hundreds of yards around the world that they can move the equipment to. They make money painting the equipment. They have a bunch of auxiliary services. It's a little bit different business than what we have. Liquidity Services actually acquired my predecessor company. They have a very good, that we don't, government contract base that brings in a lot of their revenue from the government, and they do some retail, but they don't have our financial assets business. And but might be obnoxious to say, I think we're a hell of a better auctioneer. And that's in the proof that with 100 people, we made as much money in industrial auctions as they did with 700. So that's financial facts. So we think of a company like them as a marketplace, is what they're trying to be. We think of ourselves as a market maker. So as a market maker, our advantage over them is we're happy to deploy our capital every time. We're happy to take possession of the assets every time, and we're happy to act as a principal. So it's kind of like they're trying to be the NASDAQ and we're trying to be Goldman Sachs.
So I want to ask you a question. I know you don't like this question. Let me ask it anyway. How do you think your company would be valued if these are separated? Like if the financial asset platform was by its, as a separately traded company,
higher right now. Yeah. Higher until everybody understands, because the financial asset side would get a fintech multiple, a really big multiple. The industrial side would get closer to a liquidity services multiple.
Right.
I mean, I'm not the financial analyst, it's you, but, liquidity services trades at a 35 PE doing what we're doing, trading at a 7 PE.
Right.
If you're looking at a financial asset company, nobody trades at a lower PE. So somehow the reason we're undervalued is that dumb old guy who's the CEO. I got to blame him.
Well, do you think at some point that becomes a conversation where, or do you think that's eventually as the industrial asset side becomes more predictable, what you think it will be?
I think the market is going to come to us if we continue to grow. I think the market will come to us if we continue to grow. I told everybody when it was 30 cents, you guys are out of your mind, you got to buy it.
Right.
And the guys in this room that bought it at 30 cents did quite well. I'm sure you bought some a lot cheaper.
Well,
you know?
I own some. Oh, by the way, I was supposed to disclose. I own some shares of HGBL.
Yeah. So
not 30 cents though, unfortunately, no.
No, but I'm saying, if ever there was an entry point,
right,
this is the entry point. And I said that then, but I can say it now once again. That was the time when it was 30 or 40 cents that the market really misvalued it. At $2.40, the market is really misvaluing it. And you can look at the company, he brought up liquidity services. You can look at a lot of companies, and you can look at head-to-head, and you can say, why? So that's why I'm here, to get people to take a look at least and to hear us out.
All right, great. And on the acquisition front, so if you had your dream kind of scenario, what would that look like now? If you could acquire a company
My
today?
Dream scenario would be to roll back the clock and be 40 years old.
Okay, me too.
Yeah. So, no, I want to focus on the DNA, on the culture of the company. When you're my age and you've bought a lot of companies at different times in your life in different companies, the culture is so important. Getting people that want to be here, getting people that believe, getting people to think of it as a public company with a little bit of a family DNA still. So just finding the right company that can help us, but also that we can help them. So it takes a while, and you got to be pretty picky because you got to put the right company together with the right heart and soul.
Would you think it would be more of an acquisition would be more realistic on the asset side or the financial asset side? On the industrial assets or financial assets?
I'd like to get something done in both.
Yeah, okay. Cool. And then what's that environment look like for acquisition targets?
Everybody knows,
availability.
Everybody knows we're the coolest company around, and they're all coming to us, Mike.
Okay, good. So any day now.
Yeah.
Great. Well, thanks, man. You've done a great job as usual. Any more questions before?
Yes, sir.
Yeah.
More cash oriented. It depends on the deals, but yeah, more cash oriented. We're not looking to raise money. We're not looking to raise money because we don't like our stock price at this point, and we're not looking for a lot of dilution. So we're being picky and careful. Yes, sir. They're about equal in size. So if you look at our revenue, about 50% of the revenue is coming from industrial assets, or 40%, and about 60% from financial assets. Yes, sir. I think that, we've got, there's multiple things there. Number one, inflation is really impacted in a good way the value of used equipment. The used equipment sells at a higher price, so the more we sell, our fees are a little bit higher because inflation has just created a higher price for used equipment assets. A bullish economy and a stronger economy in manufacturing has actually helped us because more people are buying new assets now, which creates a refresh of selling more used assets. So that part is working well. On the financial side, there's way more product, but at the same time, collection curves have slowed down. There's a generational thing that the collection agents talk about of all the people between 20 and 35 years old that do not feel the same obligation to pay their bills. It's just a cultural thing I can't explain. They're I didn't pay my credit card, what could they do to me? There's no debtor's prison kind of culture. So because of that, collection curves have slowed down. So we're going to have more product, but it's going to sell at lower prices. Is that it?
Excellent.
Everybody, thank you for coming. We're always around.
Okay, thanks, man.
And for full disclosure, Maj Soueidan is a shareholder of Heritage Global, HGBL.